Hello, my name is Dr. George Mochocki, and welcome back to this series, Understanding Business Organizations. Today, we're doing Chapter 16. Remember, you're either taking me an online class or face-to-face class, so your instructor provided you with this link as a quick overview using more of the traditional format, but instead of just be using PowerPoints or anything else, I'm using what we would consider conceptual maps or mind map. You see the whole picture, and we break it down. You have access to the PDFs of the second tier of my concept maps or mind maps. You are to add in your own, as you've read. Hopefully, here's how you prepare for this course or most of the classes. When you read the book, I know it's always said read once for pleasure, second time for content. Most of us have a very hectic life. Like it or not, it just said. So what happens, the first time I would read it, I would take notes as if I would be in the classroom. And utilize the mind maps to second tier. That will give you good outlines. You see the whole chapter right here, everything we're going to be talking about here. And then the second tier, as you go on, you could add on to it in your own verbiage, what makes sense to you. So we all learn in our own way. So you could do your own verbiage and add to it. Okay? Now, what's going to happen is now after you go to class, you listen to the lecture, you read the book, you answer the questions in integrative software that is provided with the publisher within this course, and now you come back and you're ready for the exam. This is an overview of everything you already discussed in the classroom or in your forums if it's an online class, and now you're just saying, what did I miss? I've read here, and by going through these different stages, using the concept maps, the reading, the lectures, the interactions within the classrooms, you're beginning to understand not only just the definitions. The definition, just look up the conceptual ideas and how they fit into business, how they fit into this area. What's the importance of banking from a small to a large business? I have to understand that concept. Okay, so today we're going to be talking about understanding the role of money and the role of banking. So what is money? We're going to talk about money. Bitcoin's another form of money. We're going to explain a little bit about Federal Reserves, how they come up with whether we're in inflation or recession, or what's going on, and how does the Federal Reserve utilize certain tools to make corrections within the economy. We're going to talk about the money supply, how does money created, what's backing the money. We're going to talk about different financial institutions, commercial banks, savings, and non-banks, which you read about. We already talked about the growth in financial services, international services, electric fund transfers like PayPal or your debit card, for lack of better words. How do banks create money? We talk about regulations that affecting banks. And remember, we got the regulations now. We just went through an election. You have a new administration. Are they going to be more tighter regulations within the banking, or are they going to loosen up some of the regulations in the banking? And this we're going to find out. But some of that depends on the Federal Reserve. And so when you're looking at what's going on, okay, let me go on. Then, how do you control the money? How do you change money in banking systems? Automatic clearinghouse or network. Impact of electronic technologies, your smartphones, your chip on your MasterCard or Visa card for security issues. UN International Bank Structure, like it or not. If you look at the United Nations, the World Trade, and we'll talk about that. The International Monetary Fund and the World Bank are basically UN apparatus of that structure, or some may say the world order. If you really look at it, the world isn't a flat economy, but it's kind of changing now. You got China's kind of trying to pull back a little. You got some of the other countries in the European Union. They say, hey, we want to have a little bit more control on our sovereignty. So there's a lot going on. So it's flat, but it's kind of like a shaking or a moving. So, but what you're going to find out now, the banking is, where do I invest my money? Do I invest it in the United States? Do I invest it in Mexico? Do I invest it in China? Which one will give me as a higher return, has stability, has currency, that's when we talk an exchange rate, maintains its value over time? I understand the value of currency goes up and down, but overall, it's a solid currency. I'm not too worried about it. It wouldn't be like the currency from Venezuela, where right now they got 500% inflation. That currency is worthless, for lack of better words. You know what I mean? So I'm looking for a currency. I want to return. I would like to risk, but what do I get? Even in Venezuela, if I don't want the currency, how do I barter for some of their assets, the oils, low prices, try to lock into some kind of agreement? And that's part of understanding money. And later on we're going to talk about investments. I think in the following chapter, and we'll talk about more about the futures and commodities in general. This is just the banking industry. How do I get a loan? How do I understand what the industry is doing? Now, before I start, we did a couple chapters a while back. Trying to rewind and economics. Now, when I'm looking at the economy, in this chapter about the banking has certain tools that basically either stimulates the economy or slows the economy, depending on the inflation or the growth or whatever it wants to do to the economy. Now, you have to understand there's two forces working in all economies. One is fiscal, and that basically is government taxing, separate bodies. Either Obama administration or the new Trump administration, whoever comes in, just a taxing. Okay, and also the spending. So that affects the economy, how much the government is spending, and that means how much, if it doesn't have the money to pay for what it's spending for, it sells its U.S. treasuries. Okay, so then it's doing debts, but at what cost? You know what I mean? So when I'm looking at that, but that's what the government can control: the spending and the taxes. That's where it gets its money to provide the services that we, as citizens of the United States or whatever country you're, from. I got international students also in the classrooms. The same banking. You have a central banking system in your host country. Majority. Some use like the U.S. banking, but the larger economies have their own central banking. Okay, all right. So far, so good. So that's the fiscal, the taxes. What we're going to be talking about here is the Fed. So when they talk about the Fed in your chapter reading and in your exams or anything else, the Fed is basically the Federal Reserve, the central bank. Okay, so Fed. Now the Fed has several things you're going to learn. You're going to learn about the open market. You're right. You're going to learn about how they control the discount rates. You're going to bring money in, bring money out. You're also going to learn about the reserve requirements. How do I take money? How much money do I have to keep for every dollar that I get in, and how do banks make money? So we'll discuss those, and that's how it. When it sells securities or raises the discount rate or raises the reserve requirements or lower them, all those are tools that the Fed, the Federal Reserve, the bank, utilizes to adjust the economy. And remember, now the fiscal policy, that's what the government does with the taxes and what do you call it, and spending. Okay, and there are two separate entities per se. So politics shouldn't affect one or the other, because this is more like remember, if you look at the Federal Reserve, the more you do the reading, it's basically a corporation, a business corporation that lends out money to banks within the setup for the government, for lack of a better word. I'm a business teacher, it's a business class. Okay, so let's go forward. So let's go on here. I'm going to try to keep this under an hour. And remember, we already discussed this. Use your book as your resources. If you happen to find me on YouTube, to look up the local community colleges. If you don't take myself, take any instructors there. We have the same experiences. We're not. We got the same qualifications as your full-time instructors. Only we're contractors. So we basically bring you real-life experiences, because most of us are in the field that we are lecturing or discussing. So you have the academic knowledge, and you also have the experience knowledge. Not just book knowledge, you have the practicality. Okay, so what's money? Like I got this guy made up of money. Let's look at money. Okay, so money. Modern money. Let's talk about modern money. Generally takes the form. Okay, I'm going to make this a little bit larger. Remember, I'm going to go through this. I read it through. I go through it. I throw some examples in here. But this is just a review, okay? And so those of you who are listening to me on your smartphones and not viewing it, or just turn me off and just or listen to me as a review, I go through all of this, or you could always stop me and focus in and write in. So you should have most of your notes there. This is just what did I miss, or it should be a refresher that you are taking good notes. And by doing this, by, again, writing with your hands, you are activating more senses in your memory. The more senses you activate, the higher probability you remember this when you need it for the exam or when you're in your business. Okay, so let's make this at 200. And as those of if this is the first, I go through the same thing because a lot of times I know if this is the first time you listen to my kind of a lecture, so I kind of give you a little bit overview. But I'm live. I very rarely do any editing. This is what you get. So I make a mistake, I go forward. Once in a while, if I do something that's really off, I'll try. I can do the editing, but I try to keep current and I update my YouTubes. Okay, generally takes the form of stamped metal or printed paper issued by governments. And here's the 50 U.S. Here's what yuan, the Chinese. Those are, China, for lack of better words, has overtaken the U.S. As an economic power engine, stronger. We still buy a lot from them, but just look at the number of people, 1.5 billion Chinese, a lot more there to stimulate their economy. And a lot of times it's not only global, their economy, even though it's slowing down, it's also internally could keep itself going. Okay, and then this one here, I think this, the euros. So you look at different currencies, different banks, central banks. Okay, anything people generally accept as payment for goods and services. You're looking at debit, smart cards. We'll talk a little bit more later on about when we get into the technology of this. Okay, so what are money standards? One thing about a standard, it's got to be portable, divisible. You could break it up in little pieces, stability, durability, and uniqueness. Nowadays, more and more, even if I look at my own wallet, I have very less dollars, currency. I'm either got a debit card. We're going through the electronic. Like it or not, everything is so much easier. It gives me a paper trail. I can put money in, paper out. I don't have to have a wallet of this kind of money. And if I lose my debit card or credit card, I have certain protections I could stop so that activity or those units being transferred to somebody else's for purchases or just to another person's accounts. Okay, so what's the function of money? Okay, let me just go with this. I'll give you the basic, okay? The function of money, it's a medium of exchange. It's a store of value. Remember, money is a store of value. That dollar, what's the word today? It could be, if it could grow and work, it depends on what people think you could purchase with that dollar or the currency you're using. Now, if I got a cow or a certain thing, look at a certain commodity, I may not be able to get that. So let's go. It's a medium of exchange. It's a store of value. It has some value. It's a measure of worth. Okay, medium of exchange. Trading money for a new fence. Money is used to buy and sell things. I don't have to have an item. It has a certain value. Okay, without money, will be bogged down the system of barter. And then later on I'll talk about barter. It is a store of value. A rancher whose cow gets sick, and this is according from the publisher, on Monday, wants to buy some clothes the following Saturday. By that time, the cow will be dead. So remember, money, even though when I buy something, it has a value. That's all I was trying to say. And we explain that in classroom. In the form of currency, money can be used for future purchases or store, and it stores the value. But remember, the currency could go down depending on inflation, depending on how much of the same currency there is. Remember, when you look at the gross domestic product, that's a reflection of the output of the workforce that currency is representing. Some currencies basically are backed by a commodity like gold or silver. Very few. Most of them are backed more by the output. Or some currency like in Venezuela, I think it's more backed by the oil, because that's basically their whole production cycle. So when the oil prices drop, so their currency, their value really dropped because of oil. It was a reflection of what can I buy for oil and it's transferred into a currency. Okay, it's measure of worth, and I think I just jumped ahead. Money lets you measure the relative values of goods and services. All products can be valued and accounted for in terms of money. This is just did a duplicate my error. Okay, so if you're really looking at the value of money, how much are you worth? When you look at this grade, when I give you so many points for doing certain tasks, look at that in academic currency. I want that an A. You have to do so much work to get that currency, to get that A, to buy, I don't say buy that A, to earn that A through your testing and everything else. Okay, now if I'm looking at barter, now barter is what you're looking at going on in India when they're talking about the black currency. And I just kind of throw that in there. Because if I'm using a currency, something like a Bitcoin, we'll talk later on, the government may not know who has it. How do I tax someone? So when I'm using something else with a bartering, I says, hey, I will cut your hair, but I'll fix your fence. Because it's worth so much dollars, so much of a currency, and the fence repairing is so much currency depending on the work there. And so instead of exchanging the paper transaction, just exchanging either services for a service or a good for a good. The problem with that, is that there's no interaction with the government because no cash exchange, no currency, no paper trail, for lack of better words. The government doesn't get its fair share of the taxing for you to make that transaction within its economic system. Uh, okay? Okay, so direct training for goods or services, and here's what you do. You know what I mean? You can't. I only want a half of fish, but what are you gonna do with the other half? So instead of that, you sell the whole half and whatever, and then you utilize the currency. Okay, now Bitcoin. I'm gonna talk about this real little. A Bitcoin is a digital currency created in 2008, and here's the Bitcoin. It's attractive to many users. Okay, because there's no central regulating authority. Remember, when you look at currency, your debit card and your charge card, the currencies, when you look at the clearinghouse we're going to be talking about, is the government or the banking system that's basically the logistic arm that says, yes, this paper is worth so much, you could do this much, and you know what I mean, or you could get so much services. So they're the ones to make sure. In a Bitcoin, there is no one watching. So there is, but there isn't. So remember, I'm not going to go into the detail. Take me for finance, we'll go a little bit more detail. I just want you to be aware that Bitcoin is another option, and a lot of businesses do accept Bitcoins in there. If I'm looking here at transactions between only two people without the middleman, however, this makes the value of Bitcoin a little difficult. So you're just buying to see what you have on the open market. Okay? Sorry, I just had another my office, so I have different systems I have running. Okay? I apologize. Okay, Federal Reserve System. Let's talk about, okay, so now you know what money is and everything else. Let's talk a little bit about the Federal Reserve System. Now, the Federal Reserve System, who is the chairman of the Federal Reserve, is Ms. Janet Yellen. She has a couple more years. We have a new president. He can't fire her unless she quits. You never know. Sometimes the individual will leave the office, and then he could appoint the next chairperson. But she's appointed for, I think, a 4-year term, and it just ended up the terms are in between elections. So is to make the continuance of the policy to a different administration. Remember the fiscal policy, but the monetary policy, which she or that office, that title has authority over, should be separate, so you can keep the economic policy engine running through a different type of adjustment for a new administration coming in. Okay, first, a female chairperson of the Federal Reserve, earned her doctorate in economics from Yale, was appointed to the Federal Reserve Board by President Clinton. Almost every factor related to the economy is influenced by the decisions she makes. Very powerful position. Okay, that's just the Federal Reserve. Now, financial institutions. Let's see what I got. Federal Reserve. Oh, how banks create money. Okay, let's go. Okay, so we got the Federal Reserve to talk about. Let's talk about the money supply. You have money supply 1, money supply 2. Okay, so if I'm looking at money supply, amount of money the Federal Reserve makes available for people. This is just regular money supply. Okay, then I have M1. M1 is what we're utilizing in economic equation. There's always M2, but M1 is basically a measure of the money supply that includes only the most liquid, spendable forms of money. Coins, paper, traveler's checks, debit cards would be considered part of the other one. Currency, government-issued paper, money, or metal coins. And, they talk about checking, and in a business we call a check a demand deposit. Order instructing a bank to pay a given sum to a specific person. Checking account, demand deposit, again, business terminology. Bank accounts, funds owned by the depositor that may be written at any time by check or cash. Now, for the economic value, when you're looking at how the economy is doing of a nation or anything else, you're looking at M1, money, most liquid, and M2. So let me explain what that is. M1 money supply that includes all the components of M1 that we talked about up here, plus forms of money that can be easily converted into spendable forms like savings accounts and mutual funds. Most common definition M2 for economics. Okay, I'll leave it go. Time deposit, bank funds that have a fixed term of time to maturity and cannot be written earlier or transferred check. Certain deposits I have, they have a time limit on there that so allows the bank to utilize the money for whatever activity it wants to, but then I can't take it out or pay a penalty. But then when the time comes, I get some kind of interest or something like that, and I could pull it out. It kind of looks like your now account, for lack of better words. You got to keep it $500. I'm trying to find some kind of comparison, not exactly, but so in your mind. Remember, my whole job of presenting the information here of banking, so you conceptually see what's going on. And then later on, you'll take economics and other or finance, and we'll go into more of a detail with the mathematical formulas to justify the outcome, or how does that come up with the conclusion. Okay, now M2 is your big deposits like institutional money and money market. Okay, let's get some facts about money. In 2009, the U.S. printed 26 million bills a day. Each penny cost 1.6 cents. Each nickel 6 cents. So look, the coins, it cost me more to make the coins than it's worth. But look, you have less and less coins. Everything else, the pop machines, the candy machines, everything else is going with your debit card. Everything else, pretty soon with your smartphone. 2/3, let's see, most track bill is where did George go? Traveled around 4,100 miles in 3 years. 2/3 of all US 100 bills are outside the U.S. Jeez, now I know where all my money went. Just kidding. 90% of paper has traces of cocaine. Remember, the money is not the root of evil. It's what you do with the money that makes the root of evil. Okay? Now, financial institutions. Let's talk about some financial institutions. You have federally insured commercial banks. You have savings and loans association. You have credit unions. You have mutual savings bank, non-deposit institutions and non-bank, and then a little bit of prime rate. We could talk about the prime rate up in here when we look at some of the policies. I just kind of throw it in here to build it up. Remember, I'm looking at the whole picture. I'm trying to help you out. Okay, federal insured commercial banks, federally insured. There could be commercial banks in the U.S., a small percentage, I think like 1 or 3%, that are not federally insured. They're still very solvent. They're very high banks, but they may be they're insured by their host country because they're international banks. But make sure that you see, just because there's a bank here operating in the United States does not mean that they're federal insured. It's like I could drive a car in the United States, doesn't mean I have insurance. I have to ask for the insurance for that. I could still operate in some states, in some other states, like in Illinois where we're at, you have to have insurance. Okay, company accepts deposits and that is used to make loans. Remember, it's commercial insured banks. Earn profits. Okay, so let me just put it up here. Earn profits, okay, interested depositors, and pay dividends to its owners. Some facts, and here's where I come up with the fact. There's 5,900 commercial banks, such as Citigroup, Bank of America, Chase in the United States. U.S. Bank holds assets totaling more than 12 trillion. It means assets. They have that, they could sell it up to 12 trillion, consisting of a wide variety of loans to individual, businesses, and governments. Now, savings and loans are basically savings and loans, but they used to not be able to do certain aspects. There's certain laws that were changed. We technically finance will go into that. But financial institution accepting deposits and making loans primarily for a mortgage, a home mortgage. That's still their main mission, but they do everything else that a commercial bank does. But they're all their whole savings account and everything else is to be into the housing industry, for lack of a better word. And it can be commercial housing or residential housing. Okay, now your credit unions, if I look at credit unions, still a banking, it's like an association, non-profit, cooperative financial institution owned and run by its members. Each credit union decides whom will serve. Such groups of employees in a particular community are members of an association, like many universities, U.S. Navy, Army, military, for example, have credit unions to help their members. They understand their members, and maybe because, like, look at the military. A lot of people may not want to give them loans or anything else because their pay may not be there. They're always transit, moving around. So they may have a credit union that understands their necessity and works within that culture of Navy, not only with individuals but also within the bases. And here when I teach at College Lake County, you got Great Lakes. I'm going to teach at Harper. There's reserves, so there's more active with the police department and everything else. Different police communities come in there for their degrees. Okay, mutual saving banks. Oops, I got something going. Not a good sign when they're spending, right? There it goes. Okay, mutual savings banks. Financial institutions whose depositors are owners sharing in its profits. Remember, banks is a business, makes a profit. All profits are divided proportionally among the depositors who receive dividends. So about 600 U.S. mutual savings banks attract most of their funds in form of saving deposits. I have a lot of money. I got a nice return, but then I put the money into my savings accounts and I put the money into these mutual savings, and they do the investment, and I got a return on that. Hey, I could put larger chunks in. It's a lot safer when we go in the financial. It may not be the best return on an investment, but it's a better return than other investments. I'm looking at safety and stability. Okay, non-deposit institutions or non-bank, and just so you see, you have pension funds. Remember, non-deposit funds managers provide retirement income for its members. Public pension funds in the United States include Social Security, $3 trillion in retirement programs by state and local. If you're looking in Illinois, geez, I know we're underfunded. I teach at a community college, so hopefully I'll get a pension. You never know, right? As part of the requirement. But what I'm looking at, but it's still, those are the private. Social Security, they most likely would do, but someone has to pay for it. But because they haven't been funding the pension fund, that's the problem. It's not that they don't want to give it to me. They say, hey, we need the money for someplace else. We never refunded it. Okay? And now they have to pay out, so that's where it's hurting. Okay, now insurance companies. If you look at insurance companies, non-deposit insurance institutions that invest funds collected as premiums and charged for insurance covered. They invest these funds in stocks, real estate, and other assets. Earnings paid for insurance losses, such as death. Remember, you give me money to pay for some losses. What do I do with that money? I don't have as much losses as I'm bringing in, so I take some of that money and I invest it. And then when I have the return or the dividends, that's what I pay for on my. If I have to pay out for, because I know statistically, so many people are going to die, so many people are going to have an accident. I got to pay out so much. I got money coming in, but what do I do with the extra money? I reinvest it and make more money on that. And instead of taking the money out where I invested, I'm just making money off the dividend. Same kind of a strategy you should do. Invest now, so when you get older, you don't have to take the money out. You have so much money in there, you're living off the interest. And if you need that other money for some kind of a big payment or to do something, you could always extract that, because then you won't have any penalty. You just have to pay the taxes. You see me? So when you're looking at finance and banking, you have to understand the banking industry. You have to understand the laws, the rules. You have to understand, because they're the ones making the money. They're the ones giving me the money. They're the ones taking money. If I had the money, and if I'm getting 0% interest, hey, the bank wants to give it to me. That's where I would go and use my money and make invest it in something else, and use their money for nothing. You remember, they're always risking. The banks are always risking that I would make and I will default. The odds are in the favor of the banks. And then the rates go up, and by the time you could come back. Okay, now financial companies, non-deposit institutions that specialize in making loans to businesses and consumer. HFC, Beneficial, for example, offers mortgage refinancing and personal loans. Consumer finance companies devote most of the resources providing small, non-commercial loans to individuals. And you also got like Wells Fargo with the student loans, for lack of better words. I was kind of throw that in as a finance company. Security investment dealers. Financial institution that buy and sell stocks and bonds for both investors and its own account, such as Merrill Lynch and A.G. Edwards. Client investors buy and sell stocks and bonds. They also invest in securities by buying the stocks and bonds for their own accounts in hopes in reselling them for later. Remember, I'm an investment in securities. I'll sell and buy for you. I'm the middle person, the go in between individual. But then also, I see a good deal when I'm doing it, I buy extra. And then hopefully, now you want it, and I'm the one that's owning it. So you buy it from me, and I can sell it back to you at a profit, and maybe lower than what the market's out there, but still higher than what I paid for it. How could I miss? Remember, I'm helping you. We're making money on money. The banking system, how does it work? How do I tap into that? When do I tap in? When do I ask for a loan? When's a good time? What's going on with the economy? What signals they're sending me? All these things you have to understand because those are environmental forces in operating a business. Okay. Now the prime rate, when you really look at it, or the discount rate, is banks offer the lowest rate or prime rate to their most creditworthy commercial customers. When we talk about discount rate, that's the rate that the Federal Reserve System, the banking system, the business aspect of the Federal Reserve. It's a business, a conglomeration of businesses that are selling securities for the government and making a profit on that. So what's the lowest rate? So when they raise the discount rate, right? That's the best rate from the Federal Reserve as a bank could get it. I want to make some money. So if I get it for 3%, I may go with +1. Like here, markups over prime +1. That's for my best customers. I'm giving you. I'm just making enough money for transferring, taking care of the money. Bringing it from the Federal Reserve. That's what I got it for, and transferring it. Look at it as a good or tangible value of something to you. You know what I mean? You can borrow it at 1%. Now, if you aren't as good of a credit, you don't have a good credit score as a business, then I'll give you the prime rate plus 5 points. Holy shit, that's 8% you got to pay. I got to pay 3% back to the bank and 5% I'm making, but you're a risk. If you pay off later on, you can negotiate it, okay? So here's the chart. When I look at the chart, it's going to tell me from 2000, here's our discount rate. And then we had the Great Depression, if pretty darn close, whatever you want to call it, all right? And now we've been flat. We haven't raised our discount rate for so long. Eventually, you have to raise it up if you want to make some money in investment. It's good for me if I want to borrow it. The bank aren't going to, they got the money. So, hey, why did I give it to you for 1%? And what if you default? You got to have that real good credit wording. Now, if I could get some interest on the money I have and say, hey, I'll give you 5%, you could go up to 10% because he or she has poor credit rating, we could basically. So there's a little pause in there. My grandson comes in. I'm in my office. And my office is part of my home. I do consulting on this side. So now if I can't make money on my product, I just hold it. Why sell it? It's safer. I'm making something. I invest in other currencies outside the United States. I'm a bank. I'm a business. So I invest someplace else, and I get some returns, or I lend out to international investors because I get a higher return, maybe a little more red. Now that the interest rates are going to go up, I will start investing in here because I can make some money. For a business, hey, I couldn't get the loan before, even though I had a good credit. Now the interest rates are higher. Now I could get the loan. Hopefully my return on my investment will be higher than what I paid to bring the business up. Okay? All right, let's see what we got. We have 30 minutes. I got another half an hour to go. We're doing pretty good. The growth of financial services. Individual accounts, IRAs, tax-deferred pensions, wages earners set up to supplement retirement funds. You have trust services, management by a bank or a state investment. When you get to a certain age and you don't want to go into the state or the will, you know what I mean? You could create a trust. And if I create a trust, like I created a trust, then no matter what, if I pass away, it doesn't go into a will. The trust says this property goes here if these conditions exist. Makes life real easier. And plus, it also protects the individual. Okay, international services. Letter of credit. Okay, promised by a bank to a seller to meet conditions. Banker's acceptance. Promise a bank will pay. Money exchange. Rate one government, charges another. Electronic fund transfers, right? Communication. We got PayPal on here. Communication or fund transferred over a wire or microwave cable. In various automatic transfer ATM machines. Elaborate machines allows to conduct account-related activities 24/7, 7 days a week. There's about 445,000 machines located in the U.S. Jeez! You don't even need a bank anymore. And really, you really don't, because everything else you don't really. I very rarely go to a bank. If I need the cash, I go to ATM. But most of the places accept debit credit cards. Global dispersion of ATM or dispersion of ATM. Look at this. Asia has 32%. North America, we got 20%. Western Europe, 20%. Latin America, 11%. Others. Good. How do banks create money? Here's the chart. when you're really looking, I talked about this. I just leave the chart up. Just look at it. I make a $100 deposit, money held in reserve. I got to keep $10. Money lent $90. So basically, here's how much money I got: 100, and lend it. You see, so I really made money 190 because I've got this. I lend money out, and then I take this 90, and then I get a deposit 81, and we'll follow it through. Take your time, see what's going on, and read it. And remember, we talked about this in class, and you finally understood it, so I don't want to confuse you anymore. Okay, so what do we have now? We have right here. Okay, so now we got regulation of the banking system. As I talked before, protecting depositors' money, you have the FDIC, or the Federal Deposit Insurance, and independent agents of the U.S. government that insures federally insured commercial banks up to $250,000 per account. So if I have $300,000 in one account, leave $250 in, take the other $50, open up another account. You're only insured to $250. Come on, if you had that much money, I don't have to be talking about that because you already understand the money. And SAFA is basically for the savings and loan insurance. Remember, make sure it has federal insured on there. They could still be operating in the state. Could be insured by the state. They may not be insured by the federal government. It could be insured by the host country if it's international, for lack of better words, international bank operating legally in the United States. So you have to see what kind of insurance, what kind of rights you have. How stable is that country? We learned that in economics. Okay, National Credit Union Administration. Again, all of these provide. Okay, so now let's talk about the Federal Reserve System. The Federal Reserve System, or what we call the Fed, and then it'll make sense how we finish the rest of this, is, let's see, let's close this off here. Okay, the Federal Reserve System, the Fed, is a central bank of the United States, which acts as a government's bank, serves commercial banks, and controls the national money supply. In essence, this is a corporation. You buy stocks in it. This is a business. The Federal Reserve System is a business. It's basically is the logistic of the Federal Reserve to get the money and bring money and help with the tools we'll talk about later. Okay, so now that's the Federal Reserve. So far, so good. Now, the functions of the Federal Reserve is the government's bank, number one. It's the banker's bank, and it's the check clearing and controlling the money supply. We're going to go later on how it clears the check when we go into the electronics. Okay, the Federal Reserve chairperson controls the money supply. And right now, we talked about it. It was Janet Yellen. Here she is. Remember, we talked a little bit about earlier. She's the one who is as powerful, if not more powerful, than the President of the United States. Got the money, controls the money supply, makes money. Not really does print money, but makes sure she follows the rule. What is she going to do with the interest rate? She could slow the economy, hurt the economy. Her job, or the job of that individual, the job of that office, position of that office, is to make sure the economy is vital, the economy is growing. Or, if it's got too much inflation, how to slow the economy, how to increase the economy, stimulate the economy, so everyone is working full employment, whatever the rules are, considered full employment, and and society is utilizing its resources to its maximum purpose. Okay, so let's look at the structure of the Federal Reserve. When I look at the structure, I got a board of governors, you got 12 reserve banks, right? Board of governors determines U.S. monetary policy, supervises 12 Fed Reserve banks, has 7 members appointed by the president, 12 reserve banks. Now, here's what you look at. When the Federal Reserve comes in here and it says we're in a depression or we are in an inflationary movement, how does that happen? How it happens is it has these 12 offices, and it takes the economic pulse in that region. It takes the economic pulse in Region 9. It takes the economic pulse in Region 10. We're in the Chicago Region 7. It takes all these pulses. Data is collected on the economics, the unemployment rate, the inflation rate, the consumer price index, the warehouse, wholesale price index. It takes all this information and it says, here's my results for my economic condition in this region. and add it takes all of these information and it takes up the average. So it'll say yes, we're in a depression, we're coming out of the depression, or we're doing something. Now remember, as a whole, we may be in a depression or a recession or coming out of it. Some areas may come out of it faster, some areas may not even feel it because you're taking an average in this class. You're taking me for a class. I got B's, I got A's, I got D's, I got C's. My average may be B minus, most usually my class. A B minus, but I still got my F's, I got my D's. Doesn't mean everyone got a B. Some people got A's, A pluses. They're above what the average. So when you're looking at this, now you know where the Federal Reserve gets its information from because it has its location or branches, for lack of a better word, in these areas. Okay, Federal Reserve banks. Okay, so now it does several things. It has an open market. 12 members policy bank. Open market sells its the treasury. Remember, it's securities. What kind of securities? It sells its U.S. Treasury notes, okay? Member bank systems and a depository. Now you know the Federal Reserve System, how it comes up. Now, controlling the money supply. The Federal Reserve controls the money. Remember, I want you to understand the Federal Reserve is monetary control of the money supply. Fiscal control of the money supply is the government, right? Your taxes and your spending. Two areas that help you manage the economy, two separate. Hopefully, the Federal Reserve, that's supposed to be influenced by politics. That's why now, with the new administration, I'm not leaving. That's what she quoted. I'm staying. I got 2 years. You can't fire me unless I do something really wrong or just, like an impeachment, for lack of better words. You have to, just to keep the continuity of the economics going forward until the administration catches on and its policy is in effect. And then in 2 years, the administration, because it's a 4-year term, will be able to bring in their own Federal Reserve and to adjust or to keep it on course or keep the same Federal Reserve. Greenspan wasn't from a Democrat to Republican because he was good. He did good. I did not say that she is not. Okay? Depends on the administration. Okay, managing money. Okay, so how does it manage money? Chart below is a list of money, right? How to control. I'm not going to go with this. I'll open this up for you so you could read it and stop it on your computer. But, right, this is what everything gets done. I'm going to go. It controls it by increasing and decreasing the money supply, open market, reserve. Remember, if I increase the money supply, if you want to see monetary policy. Okay, I'll do it this way. This is everything written up that I'm going to talk about. Okay, so here's your chart. Freeze it. Look at it. Okay? I'm going to go in here to monetary policy. It does by controlling these two factors, the money supply and interest rates. These two factors that the Federal Reserve has at its tools. And part of it is also, so the money supply and interest rate. So by controlling these factors, influence the willingness of the banks throughout the money supply, interest rate. Okay, so here's what I have. How do I control let's open reserve requirements? Let me explain the reserve requirements. The reserve requirements are for every dollar I bring in and I have available for someone to lend or borrow from me, I have to keep a certain percentage. And the Federal Reserve says you have to keep 1% or 0.5%, whatever. So if it wants more money into the system, it keeps that percentage low. If I want to take money out of the system because inflationary, there's more money chasing fewer goods, so it costs me more to get goods because it's scarcity of goods, economic. So what I want to do, I want to take some money out of the system. I increase the reserve requirement from 1% to 10%, so I no longer have 99 cents to lend out. I only have 90 cents. So I took the money out of the system, so I have less money out there. Now, if I want to stimulate the economy, because it's in a recession, I want to put more money in so people have more money, I reduce the reserve requirement from 10% to 1%, or even smaller. So that means for every dollar I have more money out there to lend to potential people who need cash to start their business or build their homes. Now, the other one they have, I'm going to jump around in here because it kind of makes sense with the reserve, is the discount rate. The discount rate is the interest rate that the Federal Reserve charges its best banks or its commercial banks. So if I want to increase money into what do you call it? Bring money into the economic system, money supply. I reduced the interest rate, so that means there's more money there. Because look, if I take a loan out and I got to pay 16%, that 16% is that 16% additional to what I took out. I no longer have that because I got to pay off my debt. So if I bring it down to 6%, or like now, I think it's like 2%, 3%. If you could get the loan, heck, that's cheap money. So I have more money. More people are buying stuff, using the money. If I raise the interest rate up, I take money out because remember, people got to pay more for that debt. The money is valued more. It costs me more to utilize that money. Now, the open market is the securities that the bank, the Federal Reserve, sells. How does the Federal Reserve, the monetary, get money? It basically sells stocks, for lack of a better word, or IOUs, or bonds, out there and say, hey, here's a bond, a U.S. Treasury bond. We need money for whatever reason, infrastructure, and so you will borrow. You give me the money, and I'll pay you back in coupons so much money at the term of the bond, whatever. Take me for fine. I'm just giving you how the Federal Reserve works. So look, if I take an IOU, that means I'm taking. I only can print so much money, and now I'm issuing a bond. I no longer are available with that money because I basically owe somebody. You know what I'm talking about? So when I issued a bond, that means I'm taking money out of the system because I can't use that. I got a mortgage payment. I don't have that cash flow anymore. So when the Federal Reserve wants to bring money back into the economy, other than printing more money, because they can't do that because it's approved by Congress, yearly when they go through that process, when they do the budget. How do they get more money into it? I basically close off the accounts, my credit cards, pay them off. I said I'm going to call the bond back. So now I'm taking that money that I can't touch anymore, you know what I mean? And I bring that money back in. So I buy them and sell, right? So I'm selling bonds. When I'm selling bonds, I'm taking money out of the economy. Look, sell bonds, money flows from the economy to the Fed. The economy slows. When the economy buys, money flows into the economy from the Fed, speeds it up. Okay? Again, we explained that in class. I hope I didn't confuse those of you. This is the first time you're listening. Look at it again in the book. It's not that hard. You just gotta understand. Look at your own cash flow. If I got a charge card, I got to pay off my debt. Now, once I pay off that thing, I have more money to spend, spendable money. Okay, so that's how it controls. Okay, tools of the Fed, and we talked about that. The reserve requirements is a percentage of funds against the checking and saving physically kept in the bank, or non-interest bearing deposit at the local Federal Reserve District. Official definition. Discount rate is the bank interest rate that the Fed charges for loans to its members. Open market operation. The Fed, when I'm saying the Fed here, I'm not talking about the federal government, I'm talking about the Fed, the banking system, the Federal Reserve. Okay? Sale or purchase of securities in the open market helps increase or decrease the supply of money by buying and selling the bonds. The federal funds rate, okay, and then talk about that, excuse me, is the interest rate at which commercial banks lend reserves to each other overnight. So I should have the funds rate. Okay, it basically is be right here underneath the reserve requirements. So here's the rate, how much I have it. So that's what's called the key, what they call the key rate. Okay. Okay, now changing money in banking systems. What do we have on here? Government intervention. Whoa. Government emergency investment assurance of repayment. The Fed loans to the bank, or what they call the government imposes various kinds of assurance. An example was for Fed holds some banks' assets are secured by banks' assets, commercial loans. Remember, the bank has some problems. The Federal Reserve say, I'm going to bail you out. Give me something in return in case you don't bail out. Or if I got to restructure you or sell parts of you to another bank to keep the bank up and running. Okay? All right, so commercial loans, banks, assets, until banks repay the Fed. Yeah, there's anything else. The Fed, remember, the Federal Reserve is a business, for lack of better words. Look at the government as one big business entity that makes the rules. In return for TARP, Trouble Asset Relief Programs or funds. The U.S. Treasury holds preferred stocks, dividends paying ownership of the banks. TARP, and here's a definition if you want to go on there. Because those of you going into finance or in business, understand when they talk about the too big to fail. Some banks, if they failed, it would have had a ripple effect through the whole banking system, the money supply system that the government's utilizing. That's why they're insured. You know what I mean? So they basically won't fail. They'll take some of these assets, or they call these toxic assets, and you as a taxpayer will end up paying for it, and they'll sell the good assets to other banks and keep the bank's accounts, the mortgages solvent, so that there's no ripple effect. That's the government interacting to make sure that you, as an individual, because your bank's been insured, 99% of the banks are federally insured, that you don't lose your and the trust in the banking system. Okay, and then the last one here you have anti-crime and anti-terrorism regulations. Bank Secrecy Act is the U.S. Department of Treasury imposed a $24 million fine in New York Jordan Bank of Arab for failing to implement required monitoring and record-keeping methods to determine funds for criminals, and then the Patriot Act. The Patriot Act gives you certain information that you are have to provide to the government when requested. There's a whole war. There's a lot of it. I'm just touching real lightly on this. I'm not trying to get into the politics on this. Okay, Automatic Clearinghouse, or ACK. Automatic Clearinghouse, what is it? It's an electronic fund transfer system that provides interbank, let me add the dictionary, interbank clearing of electronic payments for the nation's financial institutions. Network allows businesses, governments, and consumers to choose electronic over paper alternatives for payments. The system is green, safe, and efficient. Payments include internet-initiated debit, credit card payments by businesses or consumers, direct deposit of payroll, Social Security benefits, and tax refunds. She said, I like it right away. Get in my money. Don't have to worry about losing a check or it gets bad. It's instantly in there. It reduces the time. I don't know. I kind of like it. I think a lot of people, once you get it that way, it's say if you live in an apartment building or Chicago, it's nice to get it in there. And plus, the check clears right away. It's from the government. Payments include e-checks, direct payments of consumer bills, mortgages, utilities. I pay all my bills electronically. It makes it so easy. You don't have to write a check. It's there. I keep the money longer in my own Now account than I have to write a check in 5 days. Even though it's in transit, if it gets in 2 days, the minute they have the check, they don't deposit right away. They keep it as long as they could, so they could make interest on that money. Okay, check 21, making the paper go away. And all this is basically down, allows the receiving bank to make electronic image of a paper check and electronically send the image to paid bank for instant payment. And most of us do that. I don't have a steady habit. I use my smartphone of waiting days of paper to wind back to the sender. I don't need it. I can just take a picture of the check, got the barcode, everything else, take the back picture, sign, and that's just as me sending it a check. And I just shred the check here. Saves me time, saves me driving. Look how much it brings money back into circulation faster. I have a cash flow faster. Okay? Impact of electronic, where the heck are we? Okay, impact, let me just close this off real quickly so it's not confusing. Okay. Here we go. Impact of electronic technologies. Okay, now if I look at the Blink credit card, uses a complete computer chip that sends this radio frequency. Most of us got the new card. It's still the one you have to set it in. But it may have a device on there that has an RFI, radio frequency signal, okay? So what that basically does, I don't even have to take it out of my wallet. I can come close enough and it'll say, oh, here's your checking, which one do you want to use? Boom. And it automatically transfers the money. It's using a computer chip that sends radio frequency signals in place of magnetic strips that are embedded in the credit card. Contactless payment systems lets the customer or consumer wave the card in front of the merchant's terminal at a gas pump or the department store without swiping or sign the card. And it's more, you can see that in your smartphone. You just bring it into some of the terminals and it'll automatically will take the money out. Similar to toll roads and electronic passes, that avoids driver waiting in line. I got the little card there. It's all of this radio frequency. People, I come back there and it says, "Here's the code." It takes the money automatically out of my checking or debit card or charge card, however I set it up. Okay, your digital debit card, plastic cards that allows the individual to transfer money between an account. Debit card payment cards are used more than credit cards in the U.S. It's just like cash. Very few people have cash nowadays. It's usually electronic payments. And, you've got with the little square D, you go on your iPhone or on your smartphone if you're a small business, make the payments right away. Point sale purchase. Okay, electronic program and electronic money that transfers funds from a customer bank account to pay for retail purchases. And that's basically with the smart devices. Smart card, credit card size plastic card with embedded computer chip that can be programmed with electronic money. Now, smart card, if you don't have a charge card or a checking account or everything else, you can buy a smart card and refill them. To try to crack down a little bit on that, because they look at that as what they call black money, is how do I trace who purchased that item. Remember, the debit card, credit card, they have a whole history of what I did, what I purchased, when I purchased it. It's all tied to me. It's created a business profile, marketing profile, which the government could probably purchase for a cost from business that do data mining. Okay, global exchange rate. Very little on this. You have exchange rate is the value of one currency compared to the value of another. Online for a foreign currency exchange rate or FORX markets. Look it up. Do some websites. We talked about that in class. Remember, the falling dollar, if the amount of goods or service you can buy with a dollar decreases, the dollar's worth less, the value of U.S. goods goes down and foreign goods are more expensive. So if my dollar the value goes down, if I buy foreign goods, it costs me more. But if I'm selling, because my value is down, my goods are cheaper than foreign goods, and they'll be able to buy more. Overseas demand for U.S. products rise. Does it make sense? U.S. tourism increases. Goods for hotels, resources, theme parks, and retails to serve international travelers, because I get a better bang for my money. Favorable exchange rate for U.S. companies. Earning profits in foreign market is provided. Now, if the dollar rises, amount of goods and service you can buy with the dollar increases. Values of U.S. goods goes up. Foreign goods are less expensive. What makes the dollar fall or rise is the position of the U.S. economy in the global economic frame. The flat economy. Where are we at? Are we in recession? Are we buying more? Or do we owe much? Right now, I think our GDP is about 80%. We're paying off debt and everything else. 20%, we still got some cash, some disposable income. We have a large economy. Not the largest anymore. I think China surpassed us this last quarter. That's okay. Okay. UN International Banks is the World Bank. Is a UN agency that provides limited scope of financial services such as funding improvements in undeveloped countries and to help raise the standards of living. And the International Monetary Fund, IMF, is again another UN sponsored agency that provides limited scope of financial services, fosters cooperative monetary policies, stabilize exchange rate from one nation to the other. It says 188 for one book, and the other one said 150. I think your author said 150. We'll go with that one. 155, if I may mistaken. Are part of the EMF. I think this book's a little more current from my other data. Exchange foreign currencies. Not a lender. Remember, IMF not a lender. It's an overseas to make sure everyone's playing nicely. And the last one is online banking. It attracts customers for the following reason. Free identity theft protection, free credit score monitoring, personal financial management, instant messaging, and bank law. If I'm a business, I'm using QuickBooks with my point of service, my electronic register. It automatically puts all the information into my database, into QuickBooks Excel. It now could also update my checkings and my savings account by putting money into it automatically and taking money out to pay the bill. It's all done seamlessly, so I have more time to spend with the customer. But I have to understand the system. I have to have the systems in place. When I look at the reports, I have to understand what those numbers are telling me. I have to understand what's happening in the economy, what's happening when the taxes are going up. The new administration is coming in. Donald Trump's administration, next 4 years, I'll be safe by the time the next book comes in. The administrations are going to lower the tax, they're going to do all that. So what effect is that going to have at me as a business? Okay, so that's the fiscal. It's going to stimulate the economy. What is the monetary policy going to be? The taxes are lowered. Are they going to keep the interest rates lower, or are they going to raise them? Remember, all those things are affecting how I'm going to be able to do business. It affects how the customers or my clients are be able to buy my product. How much disposable income are they going to have? How much do they have to pay for the loans if they want to buy my product? How much do I have to pay? All this is, I have to know the rules of the banking, what's going on, so I can make those adjustments in real time. Okay? Whew. Boy, this is a pretty good chapter here on banking. Okay, let me just go on this. Sorry. I was going to bring it back in there, expand to level 1. And all I have to do, I'm going to end this real quickly, like I'm supposed to. A real quick summarization. So we have it 150. What are we talking? We talk about money. It's just a currency. It has value. This has to be portable. We talked about bitcoins. It's electronic going forward. I think in the next 5, 10 years, you're going to see any kind of cash. Remember, it's going to be all units. And the government's going to do that more, so you're not going to see that black money. Bitcoin's still kind of black money. When I say the black money is money that the government can't trace. When I have cash and currency, if I buy something, they don't know if I bought it from you or from somebody else. I use my debit, my credit card, or check account, or a charge account. I got a paper trail that I made that transaction. So the government knows. It knows, so it gets its taxes, but now it also knows who I'm transacting, who I'm communicating, what relationships I have. A lot of people are a little wary about that, but it's just the way it's going forward. Federal Reserve, how it comes up with its calculation, and we have something in here in the banking system. We talk about the money supply, different financial institutions, you got savings and loan, commercial. We talked about the growth of different services, international services, how electronic fund transfers, your debit card, your PayPal, how do banks make money on money when they borrow and lend it out, online banking, international bank structure, global exchange rate. Right now, small business, I can be globally through MasterCard, Visa. At the time of the purchase, when they want their money, then whatever the currency is worth, the exchange rate equivalent is what I will be compensated for. Okay, automatic clearinghouse, and you look at how you can get the checks. If you look at your payments electronically, they used to do it the checks. Now they're basically converted that operation to be with technology. For very few people utilize checks or they take pictures of checks, even at Kmart or Kmart, Walmart or Target. When you pay by check, they run it through that scanner. It's like using a debit card. Might as well use a debit card, then you don't have an extra paper. You have a little more safety if you remember utilize safe practices with your charge card or debit card. Controlling the money supply, remember taking money in, taking money out. They use the Federal Reserve, they use the discount rate, they use the open securities, okay, they use the key rate for the amount of reserve requirements. All those either takes money in, puts money out, and we explained that in our lecture, and also this real quick summarization. It explained the Federal Reserve, it's got the 12 districts. We're in District 7. I don't know if it's going to be an exam, but it's something to think about, and the regulation of the banking industry. That's it. All right, my name is Dr. George Mochocki, and thank you for listening to this Chapter 16, Understanding Money and the Role of Banking, and I'll see you in our next course, which I think will be investment, stocks, and bonds. So I hope you learned. If not, go backward, write in what you missed, and this is a summarization. I'll see you in the next time, and thank you again for listening. Okay, bye.